Today, we'll be learning what the psychology of trading is, how you can improve your trade management, including what fundamental analysis is. Also, we'll look into how to manage risk when trading and how to conduct market analysis, as well as find useful tips on how to control your emotions. Trading psychology, or having the right mindset for trading, can be just as important as knowledge, experience, skills, and strategy when it comes to reaching your trading goals. After all, being able to stick to your trading plan and make the most of your knowledge and skills depends entirely on your ability to control your emotions and act rationally, no matter what. The two main aspects of trading psychology are discipline and risk-taking. These will determine whether or not a trader can implement their trading plan. The two main emotions associated with trading psychology are fear and greed, as they can both cause traders to forsake their plans without much thought. This is why managing your emotions is a critical aspect of successful trading. We'll take a look at the two most common emotions associated with traders and what you can do to keep them under control. Most often, fear occurs in situations where the trader is trading too big. When you're under the stress of risking larger losses than normal, it can cause you to make mistakes you wouldn't normally make. Another common cause of fear is the fear of being in the wrong trade. Both of these problems can be solved by having a solid trading plan and sticking to it, no matter what happens during the trade. These emotions most commonly occur when a trade is doing exceptionally well, and the trader decides to deviate from their stops and targets and keep pushing. Greed often leads to a strong run, ending in a loss. Again, this can be prevented by simply being aware of the downfalls of becoming greedy and overly confident and sticking to your initial trading plan. Make sure you're subscribed to XTB to learn more about trading and investing.